Hello, everyone, and welcome. I'm very glad you are here because today we are going to pull back the curtain on something most business owners never get to see. And here's the truth. The wealthy don't play by different rules. They just know the rules better. They use smart legal tax strategies to keep tens of thousands, sometimes hundreds of thousands of dollars in their pocket every year. And here's the best part. Those same strategies available to you as a small business owner. And over the next hour, I'm going to show you the most expensive mistakes that cause business owners to overpay the IRS. The powerful strategies the wealthy use to reduce their tax bills, and how you can start applying those strategies before year is over to keep more of what you earn. And by the time we finish, you will see exactly why tax planning is not just for the rich. It's the smartest investment you can make in business. So grab your notebook if you want, because what you're about to learn could put thousands of dollars back in your pocket year after year. First, I will tell you a little bit about us and how our services are different from other CPA companies. And then I will explain what tax planning actually is and how it differs from traditional services that 99% of CPAs actually offering. Also, I prepared 2 case studies that shows examples of how we helped 2 of our clients, and I will go over strategies that we implemented for them, as well as savings that we generated as a result. Finally, I will go over in details and introduce 3 powerful and simple enough strategies that are missed by many CPAs. They are missed not because CPAs are not knowledgeable or incompetent, but rather because they are not tax strategists like us. Instead, they are traditional CPAs and accountants who concentrate on compliance work. At the end, if there would be time left, I would be glad to answer any of your questions. If not, I will make sure to answer those afterwards if you email me. And before we dive deeper, I want to share something special we prepared just for you as an attendee. We are offering a free diagnostic meeting with a CPA where we will review your latest tax return for missed opportunities and look at your overall tax situation. From that, we will give you an estimate of the tax savings that are available to you. This diagnostic is completely free, but there is a catch. You need to book it before the webinar ends. And as a bonus, if you decide to move forward and become a client, you will also get between $750 to $1,500 off your strategy session fee. So go ahead and scan that QR code right now to lock in your spot so you don't miss out on this limited time offer. At Custom Accounting CPA, we are not just traditional CPAs and enrolled agents, as I mentioned just a few seconds ago. We are designated tax strategists who specialize in proactive, forward-thinking tax reduction planning. What makes us different is how we design and implement customized, innovative strategies that save our clients tens of thousands of dollars every year, using only IRS-approved and court-tested methods. We bring cutting-edge knowledge, advanced planning tools, and over 15 years of experience to help successful business owners, entrepreneurs, doctors, and real estate investors legally minimize their taxes. That means that we uncover hidden deductions that often missed. We identify special tax credits tailored to your business, and we leverage little-known provisions in the tax code to cut your tax bill, while also lowering your audit risk. The result, you pay the least amount of tax legally possible, and often see a 200 to 300% ROI on your tax planning investment. Throughout the years, we have invested thousands of dollars to learn from leading tax experts across the country, investing in professionals, coaches, programs, and events to ensure we master the process the right way. We hold elite and unique certified tax coach and certified tax planner designations that less than 1,000 other tax professionals have the privilege in obtaining in the entire United States of America. In the last 3 years only, we helped to reduce our clients' taxes by over $4 million through leveraging tax code and implementing basic and advanced tax strategies. Most business owners don't realize there is a huge difference between tax preparation and tax planning. Think of it this way. Tax prep is like looking in the rear view mirror. It's backward looking. Your CPA takes your prior year's numbers, files the return, and makes sure you are compliant. But at that point, history is history. There is almost nothing you can do to reduce your tax bill. And that's how most accountants operate, reactive, not proactive. Tax planning, on the other hand, is like having a GPS. It's forward-looking. It takes into account your business, your life, your goals, and the tax code before year end, while there is still time to make changes. That's where the real savings happen. So while tax preparation is just a compliance service, tax planning is one of the smartest investments with a massive ROI you will ever make. It leverages the law to help you pay the least amount of tax legally possible, year after year. Most CPAs, tax preparers, accountants save you very little on the largest expense of your life, which is taxes. They're just preparing your returns to stay in compliance. Therefore, tax preparation is a cost, something you have to pay to comply with IRS, while tax planning is an investment that has the highest return on investment that you can possibly get elsewhere. It looks like I have some technical issues here. Please give me a second while I resolve it. Okay. I think we are good. Put it in a perspective. If you invest $1, doubling 20 times tax-free, you will end up with 1 million as shown on the left. However, if you take into account taxes at assumed 25% tax rate, you will only end up with $72,000. Huge difference. This illustration shows how taxes are our biggest expense of our lives. It also shows that without tax planning, the more you make, the more you pay in taxes. It's like paddling upstream. Now, let's go over 2 real case studies that shows how we are helping our clients to reduce their tax burden. Here is Josh, a 35-year-old dentist. Like many business owners, he was filing his tax on Schedule C of his personal return and overpaying the IRS every single year. The very first year he started to work with us, we were able to reduce his tax bill by $37,000, and we continued to deliver around the same savings for every year going forward. We didn't change his lifestyle. In fact, we lowered his audit risk at the same time. The major savings came from the advanced entity structure that we suggested for him. We helped him restructure into 2 separate entities, one S corporation for dental products and one C corporation for dental services. That allowed us to shift income into lower tax brackets. His personal bracket dropped from 30% to 20%. and the C corporation portion was taxed at 21%. That restructuring alone saved him over $21,500. Additionally, we did owner compensation study where we determined a reasonable salary that Josh should pay himself. The salary was calculated to ensure it is reasonable in the eyes of IRS, but also, very important, minimizes taxes due for Josh. It was calculated based on hours, tasks, and industry standards. This has not only minimized his taxes, but also provided audit protection. That saved him another $6,500. Because we lowered his taxable income and optimized his reasonable salary, he now qualified for qualified business income deduction, saving an additional $3,500. And finally, there were few missed business deductions that we found that were not claimed by Josh. For example, he was not claiming depreciation of his home office, as well as cleaning services he paid to clean his home. That was additional $6,000. In total, Josh saved $37,500 in federal taxes in 1 year, plus another $6,000 to $8,000 at the state level. And here's the best part. Those savings will grow as his business grows. Now, let me ask you, what would you do with an extra $30,000 to $40,000 back in your pocket every single year? You can type in a chat if you would like to share it. But we will continue for now. So let me show you the long-term impact of just 1 year of smart tax planning. Josh saved $37,000 in taxes in year 1. Instead of sending that money to the IRS, let's imagine he invests it. At a conservative 9% return over 30 years, from age 35 to 65, that $37,000 grows to nearly $500,000. And here's the kicker. He only had to do it once. Just by keeping money, he was already losing to taxes. Now imagine if you found an extra $30,000 to $40,000, not just once, but every year. That's not just saving on taxes, that's building long-term wealth. That's the power of planning. Now let's take it a step further. If Josh didn't just invest 1 year, but instead he will invest every year for the next 30 years, his tax saving alone would grow almost $5.5 million by age 65. These are two extremes, of course. On one end, he's investing just once. That gave him nearly $500,000. On the other hand, he's investing every year and built a multi-million-dollar retirement fund. But the truth is, you don't have to do either extreme. Even if you invested just 30 or 50% of your tax savings every year, you would still be setting yourself up for a secure, comfortable retirement. And that's the power of turning tax planning into wealth building. Now, let me tell you about George, who is a software development, and he's 42 years old. So he came to us while still having his accountant to file his taxes. He told me he loved his accountant. He had been with him for 10 years. First year, we simply did a comprehensive tax plan for him, but he stayed with his accountant to file his taxes. Even though his annual fee with his former accountant was not huge, he was mainly paying for tax preparation. And that mistake was costly. George ended up overpaying $31,000 in just 1 year. Multiply that by a decade, and it's over $314,000 lost to the IRS. Here's why. His accountant was simply filing returns, looking backward, without applying proactive strategies. George was getting exactly what he paid for, compliance, not savings. So what did we do for George to turn things around? We applied 5 core strategies and saved him $31,500 in the very first year. And here is how. First, we showed him how to generate tax-free income worth about $6,000 annually. I will go into that strategy in detail in just a few minutes. Next, we implemented a Section 105 health reimbursement plan. So his business could pay for his family health insurance premiums and other medical expenses pre-tax. That alone reduced his taxable income and saved nearly $10,000 per year. We also helped him open a solo 401k and contribute $20,000, which saved him another $4,000 annually. Plus, it gave him option for self-directed investing and even up to $50,000 in accessible tax-free loan funds. Then we suggested he hire his son to work in the business. That created another $3,700 in savings. And yes, I will walk you through the strategy in details later as well. And finally, we identified he qualified for the research and development credit, which delivered another $8,000 in tax savings. The result, we turned a pattern of 6-figure losses into tens of thousands in annual savings. And here is the takeaway. Staying loyal to the wrong advisor doesn't just cost you their fee. It can drain hundreds of thousands of dollars from your wealth without you even realizing it. So ask yourself, if George was overpaying $31,000 every year, how much might you be leaving on the table? But let's dive into 3-4 tax strategies that I will be covering today. One of the simplest but most powerful strategies is called the Augusta Rule, or Section 280A. It allows you to rent out your personal residence to your business for up to 14 days per year. And the best part, you don't have to report that rental income on your tax return. It's completely tax-free. For example, if rental value is $1,000 per day, and you do 14 days, that $14,000 back in your pocket every single year, completely tax-free. This is a strategy the wealthy have used for years, and now you can too. And here how it works. Your business pays your fair market rent for things like strategy meetings, planning sessions, or even company events at your home. Your business gets a full deduction, and you personally receive the income tax-free. Instead of renting space from the third party, business will pay fair market value fee to rent owner's personal residence. By doing so, it will increase business deductible expense, reduce federal and state tax bills, as well as allow you to take cash out of the business for personal needs tax-free. It's a win-win situation if structured properly. Let's run the numbers on the strategy. So depending on where your home is located, the fair daily rental rate can range from about $500 to $1,500. For this example, let's assume $1,000 per day. Since the IRS allows up to 14 rental days per year, that's $14,000 your business pays you, and you don't have to report as income. Here is the tax impact. Your business gets $14,000 deduction at 30% federal rate plus 8% state. That means $5,320 in tax savings. And on top of that, you just pulled $14,000 in your own pocket, tax-free. That's almost $20,000 of total benefits simply by using this one rule the right way. It's very important to execute and document this strategy properly to ensure it's 100% legal. And here's what you need. You need a written rental agreement between you and your business, just like you would you do if you rented from a third party. Documentation of how you determine the rental rate, whether by calling local hotels, checking quotes on sites like Peerspace or LiquidSpace or other comparable listings. Records of the actual business use. It can be meeting minutes or notes showing who was there on the meeting or on company event and what was the purpose. Also, this strategy requires a formal business entity, an LLC, S corporation, or C corporation. You cannot use it as a sole proprietor. And here's a tip. Instead of renting from yourself, you could rent from your parents. If you already support them financially, this way you are supporting them with pre-tax money while your business takes the deduction. Or if you have a friend who also owns a business, you can even rent space from each other. That makes the deduction even stronger because it's between unrelated parties. Basically, when set up properly, this is a free money that IRS says you can have. This is a strategy the wealthy have used for years, and now you can too. Let's jump into second strategy. And the second strategy I want to show you today is hiring your kids. Here is how it works. When your children legitimately work in your business, the wages you pay them become a deductible business expense. That means you shift income from your higher tax bracket into their lower one. Here is the exciting part. In 2025, a child can earn up to $15,750 completely tax-free, thanks to the standard deduction. On top of that, they can contribute additional up to $7,000 to a retirement account. And that money grows for life. If it's a traditional IRA, the contribution is pre-tax, so even more income avoids taxation. And it doesn't stop here. You can keep shifting additional income into their lower brackets, about $12,000, additional $12,000 taxed at just 10%, and another $48,000 taxed at only 12% instead of at your much higher rate. So not only you are reducing your own taxable income, but you are giving your kids a massive financial head start. Instead of just handing them pocket money, you are teaching them responsibility, building their retirement, and legally slashing your tax bill. And here is a bonus most people don't realize. If your business is structured as LLC or a partnership owned by the parent, at least one of the parents, the wages you pay your kids not subject to Social Security and Medicare tax, 15.3% FICA taxes. That means you are not only getting the deduction and shifting income into the lower brackets, you are also avoiding payroll taxes altogether. It's an extra layer of savings on top of everything else, just by having the right business structure. Let's look at the numbers. Your child can earn up to $15,750 tax-free in 2025. If you also contribute $7,000 into traditional IRA for them, that's a total of $22,750 in deductible business expense. Now let's apply tax rates. Assuming a 30% federal rate and 8% state rate, that deduction saves you about $9,783 every single year. That's almost $10,000 in annual savings, while at the same time putting money into your child's future instead of into the IRS pockets. Of course, with this strategy, it's critical to follow the rules. Your kids must be doing real legitimate work for your business, and you need to pay them a fair wage, what you would pay anyone else for the same job. Keep good records, timesheets, job descriptions, and proof of the work performed. As long as you treat them like regular employees and document it properly, you will stay well within the tax rules and still enjoy all the savings. Here's where the strategy gets really exciting. If you contribute just $7,000 one time into your child's IRA just once, by the time they reach retirement age, that single deposit could grow to over $500,000. Think about that. One contribution, never touched again, can turn into $520,000 thanks to compounding. And that's on top of the immediate tax saving that you get today. This is how tax planning doesn't just lower your current bill, but builds generational wealth. And the third strategy we will cover today is how to turn your family medical expenses from after-tax personal costs into pre-tax business expense. Here's the problem. If you pay for your own health insurance, you can deduct premiums as an adjustment to income. But for most other medical expenses, you only get a deduction if they exceed 7.5% of your adjusted gross income. For most families, that means they don't get to deduct anything at all. Those costs just come out of pocket. But what if there was a way to write off medical bills as a business expense without being limited by that 7.5% rule? That's exactly what the Medical Expense Reimbursement Plan, or Section 105 plan, allows you to do. And it can make a huge difference in lowering your taxes. The Section 105 plan is an employee benefit plan. That means somebody needs to qualify as an employee. The problem is if you run your business as a sole proprietorship, which includes a single member LLC, partnership, or S corporation, you are considered self-employed and not employee, and you cannot get benefit from the plan. So you have to figure out another way to qualify, which will depend on the entity structure that you have in place. And let's cover those entity structures and the solutions. So if you're a sole proprietor or a single member LLC taxed as a proprietorship and you are married, you can hire your spouse as an employee. If you're a partner in a partnership, same story. You can hire your spouse so long as they don't own more than 5% of the business. If you're a shareholder or member in the entity taxed as S corporation, unfortunately, you don't qualify and your spouse doesn't qualify. In this situation, your best bet is to segregate part of your income into a separate entity, such as an LLC, proprietorship, or a C corporation, and run the plan through that entity. Finally, if you run your business or even just a part of your overall business as an entity taxed as C corporation, you do qualify as an employee all by yourself. So you don't need to hire your spouse to make it work. By the way, you can also use the 105 plan for family members other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, braces, or other medical costs. You can even hire a retired parent to help cover their medical costs. The point is, with the right structure, you can turn what most people pay out of pocket for healthcare into a fully deductible business expense. With the Section 105 plan, you cannot just cover yourself or your family and ignore your other employees. The plan has to be fair. But here's the good news. The IRS gives you several safe harbors so you can limit who is covered. Specifically, you can exclude employees under age 25, employees working fewer than 35 hours a week, employees working less than 9 months out of the year, and employees who have been with you less than 3 years. So in reality, for many small business owners, these exclusions mean you can still use the plan primarily for your family benefit. Now, if you do have non-family employees who don't fall into these categories, you need to include them as well. But in practice, most of the clients we work with are able to set this up, so it works really well for their situation. Now, let's talk about the benefits. So this is where it gets exciting. Once you qualify, the plan lets you reimburse medical expense not just for yourself, but also for your spouse and dependents. So instead of those costs being personal, non-deductible, you've just converted them into fully deductible business expenses. That means you avoid the 7.5% threshold that normally blocks people from deducting medical costs. You reduce your taxable income, lowering both federal and state taxes. And the bonus, if you're paying self-employment tax, you also avoid paying it on the amount you deduct through this plan. That's another potential 15.3% savings right there. So you are not just saving on income tax, you are stacking multiple layers of tax savings, all from expenses you were already paying anyway. So what exactly can you deduct with the 105 plan? Honestly, almost everything you already spent money on for healthcare. Here's just a few examples. Health insurance premiums, Medicare, long-term care coverage, co-pays, deductibles, prescriptions, dental, vision, chiropractic care, big ticket items like braces for your kids, LASIK surgery, fertility treatments, or even special schools for learning disabled children. And even over-the-counter medications or supplements if prescribed by your doctor. The best part is these are expenses you're already paying out of your pocket. With this plan, you're just moving them from a non-deductible personal cost into a deductible business expense. So how do you know if you're a good candidate for tax planning? The simple answer is if you feel like you're paying too much in taxes, you probably are. And that means you can benefit from proactive tax planning. Here are the clients who typically see the biggest results. Those are US-based business entities making around $300,000 or more in gross sales, anyone paying at least $20,000 a year in taxes, and high net worth individuals who want to protect and grow their wealth. Now, if you're strictly a W-2 earner, your options much more limited. But if your wage is at least $250,000 or more, or you have other investments, we still have strategies that can make a huge difference for you. The bottom line is this: if you're paying significant taxes every year, you're the exact kind of person who can benefit most from what we do. As I mentioned earlier, our tax plans don't just save you money, they also help reduce your audit risk because everything we do is structured, documented, and IRS approved. Now, here is the real kicker. Our tax plans typically deliver at least 200% ROI, but in many cases, it's much higher, to 500% or even 1000%. Think of it this way. For every $1,000 you invest in working with us, you can expect to reduce your tax bill by $2,000 to $10,000. Most of our clients end up cutting $20,000 to $50,000 or more of the taxes every single year. Imagine what that could mean for your business, your family, and your future. So how can we actually help you stop overpaying the IRS? We have designed 3 options, depending on where you are in your business journey. If you're just starting out, entity analysis and owner compensation optimization, one-time service for $2,500. It's perfect if you're just getting started or want to make sure your foundation is strong. We will set up the most tax-efficient entity structure and optimize how you pay yourself to minimize taxes. This option also good if you are not sure if you're not just starting out, you've been in business for some time, but you're not sure if your entity is tax optimized and if your compensation is also tax efficient. Second option is comprehensive tax plan for $5,000 for established businesses. This is a full standalone tax plan. You can keep your current CPA for compliance, and we will be your strategist. Or we can also do your tax at year-end as well. And we will ensure that you pay the least amount legally possible. And all-inclusive ongoing tax plan for $1,000 per month. This is our most popular option. It includes a comprehensive tax plan, unlimited advisory, quarterly projections, ongoing updates if laws or your business change, and it also includes filing your business return to reflect the strategies that we put in place. The bottom line is, whether you are just starting or already established, we have a level of service that will fit your needs and deliver a significant return on investment. We're also beta testing a new offer for businesses who cannot afford to pay yet $1,000 per month. This is the offer that combines do-it-yourself plus group sessions, group consultation with CPA to answer your questions, and it will, as well as filing your business tax return at year end, and it costs between $250 to $350 per month. Very affordable offer, beta testing, and we're actually offering 50% off for the first 10 people who will sign up. So it's not featured on this slide, but if you are interested, please send us a message either by email or here, and I can provide more details on that. And beta testing 50% off is in exchange for your feedback on the system as well as your review, Google review about us, whether it's good or bad. But we believe it will be a good one, as we strive to deliver excellence in all our services. So at this point, I would like to open it up to your questions. Go ahead and type them into the chat, and I will answer what I can. And just a reminder, while you're thinking of your questions, don't forget that our limited time offer is only available if you book before the webinar ends. So while you are listening to the answers, feel free to scan the QR code to lock in your free diagnostic sessions. And again, you will get free meeting with the CPA, full review of your tax return to uncover missed savings, and personalized estimate of your annual tax reduction potential, all at no cost, but only if you book before this webinar ends. And the bonus is, as I mentioned, you can reduce, you can save $750 to $1,500 off your strategy session fee if you become a client. But one more thing, because we do very hands-on work, customized work, we can only accept about 3 new clients each month, so spots are quite limited. So go ahead, scan the QR code now to secure your free session before the webinar closes. And this is your chance to stop overpaying the IRS and keep more of what you earned. I don't see any questions coming in. Before we wrap up, let me leave you with this. You've just seen how the wealthy legally slash their tax bills and how it's your turn. So don't let the IRS keep what's yours. Scan the QR code, book your free assessment, and before the webinar ends. And remember, spots are limited, that we only can take about 3 new clients each month. And thank you so much for joining me today. I truly look forward to helping you to keep more of your hard-earned money and achieve your financial goals. Have a great day, and I hope to see you soon in a strategy session. Bye for now.